Welcome to the Tortoise and Hare Financial Podcast, where we help you navigate the ups and downs of personal finance. Your host, Jim Lau, and co-host, Ryan Genoe, discuss an article that delves into the most common money mistake that people make: living with the fear of money. Fear can cause us to make decisions that leave us with a costly financial hangover and even lead to divorce. But the good news is, financial fear can be overcome. By facing our fears and learning how to make better financial decisions, we can set ourselves on the path to a better financial future. So, let's dive into this topic and explore some of the money decisions that are rooted in fear.
Powered by Riverside.
I'd like to welcome everyone to the Tortoise and the Hare Financial Podcast. I'm Jim Lale, your host, and joining me today is my partner in crime, Ryan Genoe. Ryan, how you doing?
I'm doing great. Had a wonderful long weekend. Got lots of activities done. How about you, Jim?
Yeah, you know what? It was very relaxing. Didn't do much on Saturday because of all the rain, and then Sunday went to my brother and sister-in-law's pool party, and Monday did some work around the house. So nothing too crazy. Definitely look forward to having some warmer weather for sure.
Yes, enjoying the back patio, enjoying some summer weather. And it's great that we start talking about some of the things that we're going to talk about today, too.
Yeah, absolutely. And today we're actually talking about money decisions and money decisions that will leave you full of regret and maybe even divorced. And the timing of this topic is kind of interesting to me because this morning I didn't realize, but 4 years ago today, actually look at my watch roughly around this time, I was getting rolled down to the OR at St. Mike's Hospital getting ready for open heart surgery. So literally that was 4 years ago today. And, thinking about that and talking about fears and fears of money and things that we fear, I definitely didn't fear the surgery, and I've talked about that. I believe that there would be a very positive outcome. I definitely struggled with kind of preparing for the recovery that was ahead of me. That was a bit of an unknown, and I knew it was going to be a lot of work to get back in recovery. But the one thing I didn't fear was my finances,
Mm-hmm.
and the reason for that twofold. If for whatever reason I didn't make it through the surgery, I knew again my family was going to be protected from life insurance. But most importantly, with the expectation that I was going to recover, I had critical illness insurance coverage, and I knew that on the other end of it, I would be able to claim on it
Yeah.
and financially wouldn't have to be worried. But it kind of speaks to decisions that people make, financial decisions that people make, and how had I made a very different decision literally 10 years before I had the surgery and not bought the critical illness insurance policy,
Yeah.
the outcome would have been very different for my family financially, and maybe even health-wise, because
Yeah.
of all the stress that we would have dealt with. So, we're talking today about fear, money fear, decisions that are made or not made because they're driven by fear, and some of that fear stems from past experiences,
Yeah.
family outcomes growing up, how mom and dad kind of handled their finances, and this ultimately this topic today comes from an article that we posted recently on our social media platforms, titled "The Money Decisions That Will Leave You Full of Regret." So just as a quick reminder for everyone, if you're interested in reading the article, I will have a link to it in the description area of our YouTube channel as well as our podcast episode. But I'd encourage everyone to download our TVH Financial mobile app. That's where a lot of these articles are also being sent out by way of a notification, and there's additional resources available to you. Or you can also go to our website, www.tvhfinancial.ca, and all of our articles that we post on a daily basis are also listed through there.
Yeah.
So, Ryan, the first one we're going to talk about is marrying someone whose financial values are not the same as yours. That's a potential regret.
Yeah. Absolutely.
And right. So What are your thoughts on that? Because I have different experiences with different clients.
Yeah.
What have been your experiences in working with clients, couples who maybe don't share the same values when it comes to money?
Well, it goes back to what you said before, which is how we're raised to believe in money. And I've read articles even that it's genetic in our DNA of how some of these habits are even formed
Hmm.
from the beginning. But when it comes to any relationship or family dynamic, it really spins from the communication we and how we talk about money. And right from the beginning, you know, a large number of divorces are led because of differencing in views of how to spend money, how to save money, how to invest money.
Hmm.
So often clients, there's many different ways, and no real way is the right way, except for that you guys are talking about it as
Hmm.
partners. Because I often run into clients that want to keep their money completely separate, and
Hmm.
I also have clients that want to share everything right across the board. And
Hmm.
really, again, it stems from what both of you can agree upon when it comes to what this money situation is going to be, and maybe there's a happy medium of a blend. And again, I always say, when in doubt, talk to a financial advisor or coach to kind of talk through some of the worries that you may have with money, maybe past experiences with money and past relationships. Again,
Hmm.
we're often hurt from our past experiences with money and past relationships and not allowing those things to kind of move on to the next relationship. So,
Hmm.
you know, for a lot of clients, it's about establishing what are the fixed expenses that are tied into, running the household and making sure those are taken care of first. And then, of course, we'll talk about things like making sure that you're preparing yourself for goal setting or retirement
Hmm.
or home purchases, any major purchases. So there's no, I don't find there's any real right way that I've truly discovered, because I've seen a blend of both work really well, but it
Hmm.
comes down to how each partner is willing to be part of that dialogue, and not be scared to bring up some things that are a real concern or hurt for them. Often even said as trauma of previous experiences,
Hmm.
and those get kind of ingrained in people's habits and biology. So having the conversation and opening up, and even seeking support from outside, can really help in ensuring that you know the family life is at least being protected and good when it comes to the financial aspect. So
Yeah, I think the conversation definitely has to happen very early in the relationship when the relationship has become serious, and the couple believes that they're going to be living together, maybe even married. I think they really have to have that conversation and put a plan in place in terms of how do we approach certain money decisions. And to your point, I don't really think, in my experience, there's a right or wrong way. I think it's what works for each individual
yeah,
couple. You
yeah,
know,
absolutely,
I mean, we talk with people where we typically will have a saver, or a spender, a saver, or what we try to get them to is to become a wealth creator. And there's some individuals that are wealth creators. So,
yeah,
if I look at my personal relationship with my wife, Carol, she's definitely the saver in our relationship, and I'm
yeah,
definitely the spender and the wealth creator in our relationship. And I would say, in the early parts of our marriage and our relationship, there was a bit of an adjustment period that we had to go through. And, one of the things that we kind of struggled with at first, and where she has taught me and I have taught her, for me to be someone who's very, what's the word that I'm looking for? Um, you know, Spontaneous,
hmm,
and I buy I see something, I'll buy it because I like it, and
yeah,
I want it. Now, because of the way she is and what she's taught me is, maybe I'll pick up that thing that that shiny thing that I really thought that I wanted,
yeah,
and I might walk around the store for 10 or 15 minutes and kind of have an internal dialogue. Do I really need this? Is
yeah,
it really necessary? And I would say more often now than not, I'll probably return that shiny thing.
Mm-hmm.
And usually the shiny thing for me is like gadgets. I'm a techie guy. But before I would just do it. I would just buy it, and that was it. So she's taught me to maybe think about spending that money more so than I have in the past. And on the flip side, a lot of times she would go to a place and she would see something on sale or something she really liked, and maybe there was like limited inventory, and she wouldn't get it. And she'd come home and she's like, "Oh, there was this thing that I really liked, 50% off," and I decided against it because I didn't
Yeah.
want to spend the money.
Yeah.
And and then she would regret it the next day, and she'd go back to the store, and of course it was gone or wasn't on sale anymore. So
Mm-hmm.
I've taught her to maybe enjoy the money a little bit more.
Yeah.
So that's worked for both of us.
Yeah.
And even the discussion about joint account, non-joint account, again, I don't think there's a right or wrong. For Carol and I, we've never had a joint account. She's
Mm-hmm.
had her own account. I've had my own accounts. She's independent. I've been independent. When we first got married, we did discuss here are the expenses that I would take care of. There were expenses that she would take care of. She contributed to the mortgage, for example, in our first couple of years of marriage. So she would, send me money to make the mortgage payment. But then after that, we started a family. She stayed at home, and we still didn't maintain joint accounts. She kind of does her thing and I do my thing, and it's worked for us.
Yeah.
I also know for other couples that's they have to have a joint account. Everything has to flow through that joint account. And what I find is usually it's one of the two partners that really want that,
Yeah.
and the other partner might not necessarily want it, but to kind of keep the peace,
Yeah.
that's what they do.
Yeah.
So it's really just have a conversation about it.
Yeah.
I think where the danger is, when I deal with clients and you have two people that are both savers, for example,
Mm-hmm.
and some people might say, well, why is that a bad thing? Well, it's not really a bad thing, but I do find that their overall wealth is diminished compared to others because, again, they're holding on to every dollar. They don't want to take any risk whatsoever, which during market volatility, they're winning.
Yeah.
But long term, money sitting in a bank account and GICs are not keeping up with inflation. So they're not, building any wealth. I would say the most dangerous couple that I've worked with would be where they're both spenders
Yeah.
and they're spending everything and they're constantly in debt and they're not putting anything aside for their future. That's where I think there are challenges, and we try to help people, through that process
Yeah.
in trying to maybe change some of their habits.
Yeah, and again,
Right.
the importance of working with somebody too is helping create almost like a mild gatekeeper to help you stay in focus to what your goals are, versus overspending. And
Mhm.
I saw somewhere that even talk early and often when it comes to finances with a potential partner that you want to spend a long term relationship. I've even seen dating apps ask about credit scores, right? So
Really?
yeah, and
Okay. I haven't been in
understanding.
the dating scene for years, so
Yeah,
I didn't know that.
but it's interesting to hear how we quabble over money and understanding, and that we're setting each other up for success or failure
Yeah.
by not talking about things as important as money. And when it comes to bringing two people together, besides asking the question, "Do you want children?"
Right.
The money question is probably very quick to follow. And really, when you're dating somebody or getting to know them, seeing how they spend their money and understanding and having that as part of the dialogue will really help in the longer term when it comes to, as you said, you're out and two savers versus two spenders, or a great balance of a saver versus a spender,
Yeah.
and how that really impacts, longer term goals down the road. All those little things. And we'll be talking about this, and it's something I'm really passionate about, is teaching younger people about money and investing, and
Mm.
understanding financial literacy earlier and
Yeah.
often, and not being just scared to talk to our kids about money and
Hmm.
how money works,
Hmm.
instead of shying away from the subject, which has often been the thing for for many years in many cultures is don't talk about money, right? So we want to debunk that kind of cultural cue and make it part of the regular day to day. And, being able to talk, men and women, guys talk about money. I don't know many of my other circles that do talk about money, and if it is or isn't a part of their conversation. But how do we learn if we don't talk about it or talk to somebody that knows a little bit more than perhaps your eighth grade teacher teaching you about money in the education system. So
Yeah. Well, guys not talking about money, I don't know if, my experience is most guys, when they talk about money, they talk about the investment that they did, that
yeah,
they won,
yeah,
but they don't
no,
talk about
about
all
their
the
losses.
failures,
Yeah, they
right?
don't
So
talk
there's
about the
lots of,
fail.
yeah, they're bragging all the time about, that one stock or that one investment,
Yeah.
but they're not talking about, the huge losses with many of the other
Yeah.
decisions. So that's what guys talk about,
Yeah, I
right?
got 20%, 27% last year, but you're not
Yeah,
talking about what it was
yeah,
like during the hard times. What did you do to
yeah,
mitigate that? Who did you talk to?
yeah,
Who are your
yeah,
experts and people that you want to talk to when it comes to the
yeah.
harder decisions, right? So
Yeah. So I think really, with this point right now, anyone who's starting off in a relationship, again, looking at living together, getting married, buying a house, doing all those wonderful things, if you're getting married and you're having premarital courses with your pastor, priest, whoever, I think you should also have, a sit down with a professional expert or financial expert, sorry, just to kind of help them navigate through some of these money decisions and how they're going to handle it. One thing that I'm not a big believer of creating budgets,
mhm,
mostly because they tend to work similar to diets.
mhm.
But what I do like about going through the exercise of budgeting or going
Yeah,
through a budget is it does provide you an awareness of where your money's going, kind of like a diet, right?
yeah,
With the diet, it's like, okay, I can eat this thing, that has 600 calories, or if I eat this other thing, which I enjoy just the same, but it's 400 calories, well, then you start to make better decisions. It's like, okay, well, I'm just going to go for that other thing, which I'll save 200 calories.
yeah,
Budgeting, that process is very similar, where it's like, wow, I didn't realize I was spending $1,000 a year on Starbucks coffee.
yeah,
Maybe I should kind of change that and save myself a few $100 or $1,000. So I do encourage people to go through that process, couples to go through that process, just to see what the awareness is.
yeah. And it's I often see with younger people too asking the question, do you really think that if I'm saving $2.50 on a, although it probably doesn't cost, I don't go to Starbucks, but I
Mm-hmm.
think it's more like $7. Do you really think my $7 a month is going to create wealth that allows me to buy a house? Right. That's often the
Mm-hmm.
conversation that I get in with people, and I was like, well, it's also like a micro snapshot of understanding where you're spending and how
Mm-hmm.
you're spending it, and then again, are you saving money or are you investing money? And that's where the it kind of differs. So when people, as you said, you don't like to budget, but it is a great activity to sit down,
Mm-hmm.
look over 3 months worth of statements, find out where your money's flowing, and are those things flowing to better yourself in your own development or growth, or maybe things that are investing towards a future goal. So really, you're investing
Yeah.
in either yourself or you're investing in future goals, monetary, whether it's
Yeah.
a home or a vacation or whatever it is. So,
Yeah.
but yeah, taking those steps is an important decision in seeing, and we'll talk about this, having like you know a goal of say retirement, and how the long-term consequences of what we can do now,
Mm-hmm.
and I'm starting to work with younger people, some amazing people, that are in their early to mid 20s, and
Mm-hmm.
they're thinking about those things because they're seeing how their parents are dealing with retirement, or maybe struggling with retirement, or succeeding in retirement, and developing some of those habits now. And really an emphasis of really starting as early as possible. And this is going to weed into all the other things that we're going to talk about today, about developing greater and better habits at a younger age too. And how, investing, and, we can talk about compound interest, taking advantage, is what the seventh wonder of the world, according to Albert Einstein, or 10th wonder of the world.
Yeah.
But yeah, some things that that people think that they need to wait until they're in their 40s or 50s to start saving for retirement. Doesn't always have to be, because sometimes that's too late, right?
Yeah.
Waiting until that age.
Yeah. Well, let's talk about that, the Starbucks example, and we're not picking on Starbucks, and we're not saying people shouldn't, go into a Starbucks and grab a coffee, but you said $7 a month. I think you probably meant $7 a day. That's how much you would probably spend on a Starbucks coffee and a snack. Well, $7 a day times 5, that's $35 a week, times 2, that's $70, times 4, so $140 a month. You multiply that through a year, that's over $1,200 a year, and we haven't even added a rate of return on that lost opportunity cost. So that's $7 a day. It's over $1,200 a year if we don't add a rate of return to it, which is over $12,000 over a 10-year period. And you and I both know it's not just the $7 at Starbucks.
Yeah.
Then it's, the lunches and the dinners. So we're not the type of financial professionals that say, don't do that and stop spending money on Starbucks. But when you kind of go through that, that process and experiment, now it's no longer $7. Now it's $1,200.
Yeah.
That's significant.
Yeah.
Right. So that's very important. So let's move on to the next one, which is, another regret that people have, money regret, is waiting to invest in your retirement.
Yeah.
And this is a big, we've talked about it in recent episodes. I know we're kind of beating a dead horse here, it feels like, but we're really
creating
important.
a habit. We're trying to create a habit for people. So
exactly. Because the bottom line is even if you start off at 25 and it's $25 a month, that's developing that habit. And eventually, as your career improves and your income starts to increase over time, then we can add on to that. It's just building that habit. But it's not only important to just start to set the money aside. It's to have a roadmap.
Yeah.
To be able to see, are we, going back to that diet, right? One of the things that you typically do if you're dieting, and I'm unfortunately someone who's kind of been dieting for years. Well, now you have to measure yourself. You have to measure your weight. You have to measure your body mass index. You have to measure the circumference of your belly, and and these things are kind of measurements along the way to see, hey, is the hard work that I'm doing paying off? And what's the ultimate goal? What's the weight I want to get to? What's the size I want to get to? Retirement planning or financial based planning is really no different. We have to start the investment and accumulation part of it, but now we also have to measure ourselves against what we're doing along the way.
Yeah.
So I think the waiting part is really a major regret. You and I have worked with clients who start coming to us in their mid 50s, maybe even the 60s.
Yeah.
And they really haven't planned for retirement. They haven't done anything for retirement. I'll tell you, I've worked with clients in their 70s who are still working, and they're coming to me for a retirement plan. And they're telling me they have 2 years to retire. And it's just like, you haven't really done anything. I'm sorry, but there is no magical way of doing this. And there's some really hard decisions that they have to make.
Yeah. And I think one of the things that a lot of clients recently have been talking about is our ability to actually visually show them a roadmap of what each goal or journey may be, whether it's retirement or saving for a home, and how each little decision along the way can add up and compound and continue to grow.
Yeah.
And that, you know, it's not a linear line. It's gonna go up and down, and there's a graph that has people going up and around. This is actually the journey of life.
Yeah.
It's not like a steady climb, right? So,
Yeah.
and that we're not restricted to one particular way of investing for our retirement too. There's
Mm-hmm.
different avenues that you can look at too, to make sure that, as we've been working with a lot of clients about, diversifying how we invest towards that goal, whether it's private investment or mutual funds or a little bit of a GIC for longer term, or your home or buying a home as part of that retirement, even life insurance as a means to a strategy or a vehicle towards that. There's many different avenues that people can take when it comes to really personalizing their own journey towards retirement. But ultimately, what it comes down to is taking a first step to say, I don't see what the plan is. Help me visualize it. I'm a very visual person. Help me create a journey, as any sports person or any athlete would. They need the coaches to help support them along that journey. So, and just making sure that you kind of keep on track, and just the way we would hire a fitness coach to help us stay on track with our health goals. The same goes for retirement, and yeah, the earlier that you think about what retirement may look like for you. And I think this is something that sometimes comes up with people, is they just want to accumulate wealth, but there's no end goal of what that wealth is,
Yeah.
right? And it a goal without a plan is simply a wish. So by understanding what your retirement spending is, then you can kind of know, well, what kind of risk am I going to take through these years, high or low risk, to achieve that goal. And I know we've talked about rates of return. People are often very locked in on rates of return. I need my 20%, 20%,
Impossible.
which is nearly impossible to do, right? So understanding what you need in retirement, and that to be enjoying retirement, enjoying your years after working so hard.
Yeah.
That's I think a conversation that people sometimes need to have. What does retirement feel like?
Yeah.
And really feel what it feels like for yourself, and all the other things that may come up in retirement too.
Yeah.
We want to wait until we're retired to travel, but sometimes it's harder to get around when you're older for retirement. So enjoy, right?
Yeah.
Enjoy the family vacations and experiencing things like that. So
Yeah, I know. Even with Carol and I, we've talked about at one point retiring, and again, for me, if I set an age, it's 70-ish, because I love what I do,
yeah,
and physically I can do what I do, and the fact that now we're all pretty much working from home, it means I'm not out traveling all the time either.
yeah,
So my original thought process was 70, sell the house, buy a cottage, and kind of retire at a cottage.
yeah,
And that's shifted now for a couple of reasons. First is I've had clients who also romanticized about retiring at a cottage, and they have done so. And I've had multiple clients that have done this. And within 2 or 3 years, they're coming back to the city because they realize it's a lot of physical work
yeah,
to maintain a cottage. The winters are not as desirable when you're 2 or 3 hours north of the city of Toronto. Um, and again, there's just a physical aspect, but also whenever they have to see their doctors or specialists, they're all driving 2 or 3 hours south to visit a doctor, or a specialist. So I've witnessed that, and even in our family, I've witnessed it with some family members who live at cottages full time, and I can see what their physical situation is and how they struggle. And there was a bit of a shift where I said to Carol, maybe we need to change that strategy.
Yeah.
Maybe we need to consider doing it in our younger pre-retirement years.
Yeah.
And then when we are in retirement, depending on physically how we're doing, we might have to then sell the cottage and come back down and buy a condo or whatever. So,
Yeah.
our thought process has shifted based on seeing other people. And I think that's another thing that people need to do is look at others. And, it's difficult for a 30 or 40-year-old to think about retirement and what that might look like.
Yeah.
So speak to people who are retired and what are they experiencing, and what are decisions that they have made that they're really happy with, that have worked in their favor,
Yeah.
and what are decisions that they've made that they regret. A big one that I hear constantly: I had a whole life policy, or I was always told to buy term insurance, and now I'm in my late 60s, early 70s, and I regret not having whole life insurance
Mm-hmm.
because I didn't foresee some of these other issues in retirement.
Yeah.
So speak to the people who are there and ask them, for some advice.
Yeah.
You the other thing that we help our clients with is again coaching them along the way and making some decisions, financial decisions. I would say, in my experience, in the 34 years that I've been doing this, it's more difficult to be an advisor when the public markets are doing really, really well,
Mm-hmm.
as opposed to when the markets aren't performing so well. Because when the markets are performing well and they're crazy, like they were, for example, in 2021,
Mm-hmm.
and we're sitting there trying to kind of rein in the clients a little bit, say, hey, this isn't normal, and this isn't going to be a year over year thing. And you need to kind of maybe consider the fact that at some point there's going to be a correction.
Yeah.
It could be a deep correction. Maybe we need to adjust how you're investing your money. That is a lot more difficult to work with a client with that mindset
Yeah.
than when the markets have performed horribly and we're talking to them again. This is why we structure things a certain way. This is why we create the foundation component and we kind of layer things up. So you have a part of your wealth in investments that were not really related to the public markets.
Mm-hmm.
But we also do have other investments that will perform with a little bit more volatility, provide you with a little bit more growth. So it's easier to work with a client who's experiencing a down or a decline in the markets,
Yeah.
because at that point they recognize, oh yeah, you're right about that. So it's a teaching process that we go through with people, and I don't know how many people bought into stocks because their neighbor bought into the stock. Marijuana stocks was an example. Back in 2000, it was the Nortels, and
Yeah.
everyone was buying Nortel.
Yeah.
And, there was a warning from me, at least, would say, you got to kind of rein it, like, don't put all your money into Nortel. That's really risky.
Yeah.
And in hindsight, it was a very risky investment,
Yeah.
Yeah,
The markets, and again, the market is emotional. It plays with people's emotions. In an emotional market, that's how it reacts. So, and people are all happy when the market's up, but it can have a real effect when the market's down on both your retirement and even people who are trying to save for an emergency fund, right? And making sure that we're creating that kind of flexibility. And obviously, we've now gone through a time where people really needed an emergency fund, and the importance of building that up. A lot of clients we talked to were, throwing money at their home and making sure they were paying off their mortgage, which made them less liquid and flexible to have this emergency fund in case something came up. And so what kind of experience have you had though? The number's always been thrown out: 3 months, 6 months. Now we're looking at, after what happened a couple of years ago, you should probably have a year's worth. What's a number that you always fall down on when it comes to having an emergency fund for yourself?
Something better than nothing.
Yeah.
That's what it comes down to, because again, going back to the example of when the markets are doing well,
Yeah.
I find people are less liquid because they're throwing their money. Like real estate has been a big one,
Yeah.
and a lot of people have been putting their money into real estate, which is wonderful. It's built a lot of wealth. Again, it's something that we do at TVH Group. We help our clients with. But the thing that I caution people is you need to have some form of liquidity because when things go bad, like they kind of are right now,
Yeah.
you can't sell the door to your house to generate cash.
Yeah.
So what is there a right amount? I don't know if there is because again, every professional will give you a different number.
Yeah.
There's also a debate between is a line of credit considered a form of an emergency fund
Mhm.
or is it not? And in my opinion, is if you have a line of credit and it's not being used, then yes, that provides you liquidity in an emergency.
Yeah.
So really, Ryan, for me to say it should be 3 months, it should be 6 months, should be, I've had clients who they want a full year.
Yeah.
Wonderful. I've had clients who 6 months, that's great, works for them. I've had people at 3 months. Again, that's wonderful. The ones that are in danger are the ones that have zero liquidity.
Yeah.
And literally one bad month will wipe them out
Yeah.
and add a lot of stress. So I don't really have a rule of thumb outside of just do something.
Yeah. Just know that
You know?
whatever you're doing is giving you some peace of mind at the end of the day.
Yeah.
That if God forbid you lose a job or something happens, that you have a little bit of cushion room to help you get through that
Yeah.
and move on to the next step. And again, as I always say with many clients, is you know I should probably be the second or third call you make if something big happens in your life.
Yeah.
Um, it's always great to have our kind of advice as to what the next steps could be. Whether it's a
Mm-hmm.
passing or a job loss or a new job or baby or thoughts of buying a new home or anything like that.
Mm-hmm.
It's always great to have that secondary opinion that's often third party, away from all the emotion of
Mm-hmm.
it when it comes to family members and stuff talking around any
Mm-hmm.
subject. But somebody just a little bit more removed. So
Yeah, but whenever there's a big event in a client's family, I don't know why, but we're the last people to know.
yeah,
And that's why I like social media.
yeah,
There's a lot of bad things about social media, but I do try to become friends with my clients on social media. Part of it is just so they can kind of see me at a personal level,
yeah,
what I'm doing with my family. But part of it is because I get to see what's happening in their lives, and if all of a sudden I see, hey, we just bought a house and they didn't tell me, or hey, we just had a baby and they didn't tell me, like those are big changes that you know do require at least a quick financial review to
yeah,
say, hey, are things structured properly? Like I don't know how many people that I've talked to, clients of mine who, yeah, they've had 2 or 3 kids, and it's, have you set up your wills? Have you set up your powers of attorneys? Have you put any
yeah,
of those things? No, we've been meaning to.
yeah,
Like eventually we're going to get to it. It's like, yeah, but your oldest is like 5 years old, and you
yeah,
have two. After that,
yeah.
you're exposed.
And time gets away from you pretty quickly. I can't
It
believe my
does.
son's 8 already, right? And yeah,
Yeah.
and the flexibility of working with a proper advisor is, even we steal 15 or 20 minutes of your time, that those are
Yeah.
small little check-ins that
Yeah.
can have a huge impact on your life. And again, your peace of mind of just understanding what's going on. Are we still on track with your plan?
Yeah.
What kind of things can we do to kind of maneuver around and make sure that you're setting yourself up for success? And I
Hmm.
guess the next thing is setting your kids up for success too, right?
Right. Yeah.
And you know, as I've said before, one of the things I'm really passionate about is really teaching kids about
Yeah.
money and younger people about money. Well, everybody
Yeah.
about money and how it works. And but again, it's taking that chance to make sure that you're talking to your kids about money
Hmm.
and the
Hmm.
understanding of money, even from an early age. So, any
Yeah.
things that you've done with your kids that have taught them a little bit more about money?
Yeah. I remember when Serena, she would have been, I don't know, like 7, 8, like around Walker's age, I believe.
Yeah.
And Carol, as you know, she's thrift store queen. She loves going to thrift stores,
Yeah.
and we donate a lot of things as well that we've kind of don't use anymore, or we'll sell them to a local store. So we went through the process with Serena and
Yeah.
Liam, where we said, okay, kids, what are toys that you can give away or sell and live without?
Yeah.
And they each put like a little pile together, and Carol went. And I remember in Serena's case, I think she was able to get $20.
Yeah.
So I said to Carol, okay, give me the $20. So I sat down with Serena and I said, Serena, you sold all your toys and you got $20 for it. And of course she thought she was rich, right?
Yeah.
And she was excited. And I said, but wait, you got to give me half. You got to give me $10. She's like, for what? I'm like, taxes. And she's like, what's that? Right? And this anger that she had in her face as a little girl,
Yeah.
and I tried to explain to her what taxes were.
Yeah.
She's like, well, that's just not fair. But then from there, because I know everyone hates taxes, but then the conversation was, well, we pay taxes because it helps to build our hospitals and our schooling system. So it wasn't just trying to, I taught her about taxes, not just the bad part where we're paying it,
Yeah.
but what those taxes are supposed to be used for, what they contribute towards, right?
Yeah.
So she was still kind of pissed off,
Yeah.
but not as much.
Yeah.
And then the other thing that we've done with our kids too is, and I think we implemented this about 5 or 6 years ago. Whenever they got birthday money or Christmas money as a gift,
Yeah.
half of it they would keep and they would be able to use it and spend it however they wanted. We didn't care.
Yeah.
But the other half came to their financial advisor,
Yeah.
and I opened up a couple of little trust accounts, and I use one of our portfolio manager solutions, Modern Advisor. And what I do is I contribute into that. Even their allowance, Carol will give them their allowance, but she'll physically give them half, and the
Yeah.
other half comes to me.
Yeah.
And then from time to time, I'll sit down with them and I'll say to them, "Listen, this is how much you've given me
Yeah.
from your half to
Yeah.
invest,
Yeah.
and this is what it's grown to."
Yeah.
And if I look at both of my kids, Serena's definitely the saver like Carol,
Yeah.
and Liam's definitely the spender like I am.
Yeah.
And I remember after that, like Serena would ask and Liam would ask, well, how does that make sense? Like I gave you this much, but it's worth this much. So again, I explained it to them. And then Serena got up, walked to her bedroom, came back, and she had like $200 in cash in her wallet.
Yeah.
She's like, well, can I give this to you, Dad, to put in that account?
Yeah.
Because I'm not making money with this sitting in my wallet, but clearly it's making money if I, invest it the way you've explained it.
Yeah.
So they're kind of understanding that a little bit better.
Yeah.
And then finally, during COVID, of course, we played to my family the "What would you do if you won the lottery" game.
Yep.
And of course, with me, it was Ferraris and Lamborghinis and probably a cottage and whatever else, and everyone kind of went around, and then we landed on Liam, and I'm like, so Liam, so if you won $20 million, what would you do?
Yeah.
And he would have been about 12 years old at the time, and he's like, well, Dad, I would give it to you. I was like flattered, like, oh my God, you're going to give me 20 million. She's like, no, not to keep, but to invest for me,
Yeah.
because I know that you'll grow that $20 million for me.
Yeah.
And I thought, wow, like that was a proud moment for me, that was his thought process.
Yeah.
So I think really it's talking to them about it.
Yeah.
And we will tell them, sometimes when we go out and, we go for dinner, like I will say to them, that just costs us, $120 for the four of us,
Yeah.
and they'll be like, oh, wow, that's a lot of money, so we will have open discussions with them. What I don't do with them though, is I don't have adult conversations with them about money. So if there's, things that are coming up in, with Carol and I, financially speaking,
Mm-hmm.
we don't have those conversations in front of the kids. We don't get them involved because I think that's a little bit too much for them to handle.
Yeah.
But there's a couple of little things that we do along the way, teaching moments
Yeah.
to help them.
Yeah.
So, how about
Yeah,
you?
with Walker is kind of the same thing. The money, when money comes in for him, it's kind of like I do have 50-30-20 or a 50-40-10, which is, 50% he can spend, 30 to 40% we invest for him. And then the last percentage is being able to give back to community in some way. So
I thought that was your fee.
yeah. Oh, don't you worry. I have that conversation with him too.
Right.
But he picks charities often, anything involving saving puppies or helping kids lunches. He'll buy a little bit extra, and then like you said, when we go out, for him to understand, the when you work, you get money to pay for certain things, and understanding kind of like the expression keeping up with the Joneses, because somebody else has a flashy thing doesn't mean you need to have a flashy thing, right? And as you said, like I make him either sometimes walk around with it and make him feel whether this is something that he really wants. Or I often, for myself, I'll sit on it for 72 hours. Right? Is this something I like? If it's obviously something that's going to impact and right away, I'm not. Then of course you make that decision. So, but there are times that will be, grocery shopping. It'll be something that is just, one of those flashy things that he kind of wants to know. I'll ask, okay, do you have any money on you? And he'll be like, no. Okay. Do you want to take a loan from the bank of dad? Right. And I'll say, well, when we get home, you'll have to owe me plus interest. And to see the reaction of some parents is hilarious. And you'll see them think about it, and I'll be like, what's something that you've really been wanting to save for? And he'll say, oh, I'm really wanting to save for a bike or, a trip to Florida or whatever. And then he'll be like, I'm going to put this away for now. And I'll think about it a little bit later. And sometimes he'll come back and he's like, Daddy, I really want that. I'm like, okay, let's get it. So, but it's these little teaching moments that we allow our kids to help understand. And again, there's many different ways to approach it. There's many great articles talking to advisors about fun little activities, about, creating allowances and whatnot. And giving kids when they're a little bit older. I've seen things on, putting your kids on your credit card to build credit. And because honestly, in my opinion, is if we rely on others, the world, to teach our children our money, then it's not really going to happen. But it's our responsibility to help them understand and educate them on some of these little things. So.
Well, a recent one that came up with us is with Serena. So Serena is going to be 18 September, starting university. We basically said to her she needs to get a full-time summer job. And one of her friends, her mom, runs or works at a pet grooming place, and it offered her a full-time job for the summer. And Serena thought, this is fantastic. But then she's like, yeah, but they pay cash. And I'm like, okay, so I don't think that's appropriate for you. And she's like, why not? And I said, well, here's the thing about cash. You're going to need credit at some point. You're going to need to get yourself a credit card because you're going to have to pay for parking at school. You're going to have to pay for gas. There's going to be situations where you're going to require a credit card. A credit card requires verification and proof of income. Cash does not allow you to generate that proof of income. So that means it'll be difficult for you to get credit. And on top of that, you're going to need to have a credit history and build a good credit history. Because at some point, you may need student loans, or you might want to buy, real estate or whatever. So she had no idea. She just thought it was great that she was going to get this full-time job and she was going to be paid cash. And I talked her through it. I said, so I'd said to her, it's not that it was, no, you can't. It was, here are things to consider if you accept that job compared to another one where it's verifiable income. And on her own, she said, you know what, Dad? It doesn't sound like it's a good idea for me to work at a place where I get paid cash because of these other things. right? So it's about teaching them. And I know other people are probably going to trash me now, saying, "Wow, why pay taxes?" And, well, she's, you know what? She's 18 years old. She's not going to really pay taxes anyway.
Yeah.
And really, it's, you know, we deal with this when it comes to disability insurance. How many times have we, you know, sat with a client who's wanting disability insurance? It's a cash business. They're only claiming like $20,000 a year, even though they're maybe generating 120,000. And we'll say, "Great, we can get you $10,000 a year of coverage."
Hmm.
And they're like, "Well, that's not enough because that's not my real income." It's like, well, that's the thing. The insurance company will cover you for income that's reported,
Yeah.
and that's it. You
Yeah.
know, so there are obviously positive and negatives to both, but the system requires us to have verifiable income
Hmm.
if we want some of these other protections. If we want to again have credit, I have clients right now that are looking to refinance property,
Hmm.
landscapers, and they're struggling right now getting a mortgage because guess what? The bulk of their revenue is all cash.
Yeah.
They can't verify, and the bank is just refusing to lend them on some of their mortgage renewals or refinances because of that.
Yeah.
You know, so these are things that we need to teach them for sure. Um, you know, we're approaching the hour. I think maybe the final regret that people might have that we'll discuss here is trying to keep up with the Joneses.
Yeah.
I don't think that's something that you have ever tried to do based on your personality,
No, I
right?
uh, I do my own thing.
Yeah,
Find my own ways of joy and passion and travel and things like that. And I
yeah,
don't have to have luxury, the newest things, you
yeah,
know. And you know, we've joked about Carol and I and sharing our enjoyment of searching for things
yeah,
at the value villages and stuff like that. But yeah,
yeah,
if I want a new book to read, I go to the library.
yeah,
I go to Value Village or something like that, and buy it
yeah,
used or borrow it from a friend or something like that.
yeah,
So
yeah,
there's all these little small things that help make sure that I continue to invest my money versus seeing this something that could for some spark a little bit of joy for a short period of time, right?
yeah,
So
yeah.
I've always said when it comes to it's about books and gift giving
Right.
and doing things that create experiences
Mm-hmm.
for me and my family.
Yeah,
So that's all that matters for
yeah,
myself.
yeah,
And for everybody else, it could be something different. So, but if you want to
yeah,
make sure that now you're reaching your goals, the goals of retirement, housing, starting at even a younger age. We've done the activity of sitting down with kids that want to go and lease a new car or whatever like
mm,
that, just because you know they want to be the cool kid on the block. But
yeah,
you know, Walker's gonna get his own little beater.
yeah,
Beat up car doesn't need to be fancy. It will likely be paid through his life insurance policy because of the cash value and stuff that's built
yeah,
up in there,
yeah,
instead of risking my own
yeah,
retirement and savings
yeah.
towards that. Yeah, that's what I thought on the Joneses. The
So
Joneses are gone.
I'll slightly disagree with you,
Yeah,
but the bottom line is it's whatever works with the individual,
yeah,
right? Now, I can honestly, personally say I've never made a decision that was based on me trying to keep up with the Joneses.
yeah,
I really don't care what other people's do. You know, it's your money, it's your life. Do whatever you want. If you're coming to me for help, I'll help you.
yeah,
But I do like new things, and I
yeah,
do like shiny things, and I always have. And you know, a lot of times there was guilt whenever I would get something that I quite enjoyed. You know, cars being one of them. I've been a car guy. I'd say I'm less of a car person now than I was when I was younger.
mm,
And there was a shift that happened, and I heard someone on TV say, you know, we've heard the saying that money doesn't buy happiness.
mm,
And that's where I think the guilt always came for me, was because it's just like, yeah, money doesn't buy you happiness. And the individual's like, that's bullcrap.
mm,
And I was a bit shocked by it. And the point that he made was, you know, if you buy a nice car and you sit in that nice car, you feel happy,
Mhm.
and required money for you to buy that car, which ultimately made you happy.
Yeah.
So money in certain respects does buy happiness. And I thought about that. I'm like, you know what? He's absolutely right. When I sit down in a vehicle, or if I'm on a motorcycle, or it could be a trip, whatever it is,
Yeah.
I'm happy. So yeah, it requires money to be able to achieve, and it's not the only thing that makes me happy. I'm not sitting here saying that I can only buy fancy cars or whatever, and that's ultimately the thing that brings me happiness. Like ultimately, it's my family and my wife and my friends and my health and all those things.
Yeah.
But these other shiny things do also add to that level of happiness. So for you,
Yeah.
it might just be, I have no need for that. I don't care for that. What makes me happy is the deal.
Yeah.
I got a really good deal and I didn't have to spend all that money. And that works for you.
Yeah.
And that may work for Walker as well. Or Walker might be like me. He might just be, no, I really like the new stuff and
Yeah.
makes me feel good about it. And my kids are the same. Like Serena isn't into the new stuff, but
Yeah.
Liam is.
Yeah.
So, and I don't sit there and say to them, no, you shouldn't be that way, or you should be, but I talk to them about the consequences of the decisions,
Yeah.
right? Like, just keep in mind, if you can't afford this, it'll make you happy for a very short period of time,
Yeah.
but then you're going to be stressed and you're
Yeah.
going to deal with a lot of anxiety. So make sure that financially it is something that you can manage,
Yeah.
right? So a
And
different perspective.
yeah, no, and I agree. Like, you work hard for your money as long as you're not putting yourself in future stressful
Mm-hmm.
situations, then yeah, go ahead. And there's a country song. What's the guy? Money doesn't buy happiness, but it buys you a boat and a truck to pull it. So,
That's exactly it. Yeah.
so I won't sing the rest of the lyrics because I can't sing.
No, please
So,
don't. No, please don't. Yeah. No, we this isn't a singing podcast.
yeah, that's
but
a
you
different
know
one.
what? Yeah. But it's true. Like it's just some people. It has to. Like I know people, friends who they'll never buy anything used
Yeah,
because they're disgusted by it.
yeah,
And then I have Carol who when she goes on a weekend and she's gone for hours and she's gone thrifting
yeah.
and she comes home and I can see this look in her face, and it's
I've
because she
struck gold.
found, yeah, it's like a treasure for her. She's like,
Yeah,
look what I found. I don't know how many times she's come home and for example, she's like, I found this thing, and I'm like, okay, and she's like, well, used on eBay it's like $60. I'm
yeah,
like, all right, wonderful. She's like, but I only paid 10,
yeah.
and I had a 20% gift card, or discount. So I
Discount
only paid 8
20%.
for it,
Yeah,
you know,
yeah,
and she'd get excited over that.
yeah,
And that's her personality. And I've given her new iPhones and whatever else. And she's like, but for me, if I get a new piece of technology,
yeah,
I'm at that same level of excitement that she is when she finds that treasure, you
yeah.
know? So
I can't wait
so
to hang out with.
so she saves me money. Yeah, she saves me money so I can spend it.
Yeah, can't wait to
That's
hang out with Carol.
balance.
Yeah, that's communication, perfect balance. Yeah, yeah.
Yeah,
A little bit exciting for the little treasure hunts that you find from time to time. But
yeah,
again,
yeah,
everybody finds their own way. So, but really,
yeah.
overall, like, the importance of this is that we've talked a lot about communication and importance of
Hmm.
communication through our partners, communication to our kids
Yeah,
when it comes to money and understanding money. And
yeah,
a challenge that I ask people too is you know when you think of the word money, money is what is the word that comes after that, and that says a lot
yeah,
about how you were raised, and
yeah.
perhaps maybe even within your ingrained in your DNA of what
Yeah.
it is. So, and that we really ask people to take a few steps, just to
Hmm.
move towards, whether it's goal setting,
Yeah.
shaving a couple coffees off from
Yeah.
instead of buying the coffee, buy the stock,
Yeah.
right?
Yeah.
Start investing
Yeah.
your money in better and different ways. And as always, we encourage people to talk more about money and talk to professionals that can help guide and give it great advice. Because no two situations are ever the same, and that's
No.
the exciting thing about our jobs, is that you're kind of on the hunt of how to navigate each individual situations. Because I haven't ever run into two clients that are the same, and
Yeah.
that's kind of the cool thing, is everybody has different goals and
Yeah.
different history and different behaviors that we're all trying to navigate through. So
Yeah.
yeah,
And it also sounds like, not every advisor is the same. And you and I, we share a lot of values,
yeah,
but we have some slight differences as well, and where we can learn from each other. And we share those with our clients as well.
yeah,
So I think there's a benefit in working with a team of advisors as opposed to one who has one opinion
yeah,
or one way of doing things. Because I think I'm hoping whoever's listening or watching has kind of picked up on the fact that, yeah, we have a lot of similarities, some slight differences.
yeah.
Yours isn't right or wrong. Mine aren't right or wrong. It just works for us, and again, we can kind of bring that into the team. So we'll look at winding this up now. Just as a reminder for everyone out there, again, I would encourage you to like and share our podcast or our YouTube video. Also, as a reminder, the TVH Financial mobile app, where you can listen to our podcast there, our articles are also sent out through there as well. And there's some additional resources. We also do have our website, www.tvhfinancial.ca. And as always, if you just want to give us a call, you can call us at 647-727-4668, or contact us and email us through financial@tvhgroup.ca. Ryan, thank you once again for your time today,
Thank you, Jim.
and looking forward to the next episode in the next couple of weeks. Everyone, take care.